There we go. So yeah, as Ali said, welcome everybody. Thanks for carving out some time this evening. It's going to be about an hour. We got a lot of stuff to go through. So a lot of things tax related, and so of course we're not trying to replace your CPA or that type of consultation in any way, but there may be a few things in here just for you guys to kind of think through and talk to your tax person about. So I like to say I'm dangerous enough to break something. But we're definitely not the end all be all, but just trying to provide some educational opportunities here. So we'll jump right in. So Ali does a fabulous job of sending out both the slides and then the survey following this. We would really appreciate your feedback. If there's things maybe you needed or would wanted to have covered, definitely let us know. And so we'll have some more information come out. You could welcome to follow us on Facebook and both on LinkedIn. And so we'd appreciate the likes there and the follows on our social media. We've got some information that comes out there as well. Our obligatory disclosure slide, which keeps getting longer and longer and longer. So pretty soon, I think this thing is going to go into 5 or 6 pages of disclosures, which seems to defeat the purposes of, we just want something short and simple. But all right, so we have some upcoming topics here. We're trying to cover kind of some different areas: tax planning, estate planning, college, Social Security, and Medicare are kind of the 5 key areas that we're trying to provide some relevant information on. And again, like I said, if there's more topics you'd like to hear about, definitely let us know. And then we also have done kind of a state of the markets twice a year. We try and do that in around first of the year and mid-year as well. And we'd love to kind of get back to doing these things in person, but understand it's a lot easier to to do it virtually, but it's also hard to read, and ask questions and interact with folks. But so we're trying different ways of reaching our clients in those things. So, all right, with that, we're going to jump right into our presentation here. So here's a tax brain teaser. So as you know, if we ask a brain teaser question, it never is the answer you would think it would be. So we have a gentleman here, Bill. He's retired. His taxable income is $45,000. That puts him squarely in a 22% bracket. So on the right-hand side, you can see that tax rate schedule. So at $45,000 of income, he's in a 22% bracket. So we call.
Hey, just want to tell you, are you sharing your screen?
Yeah.
Okay. All right. I see it.
There we go. Is that better?
Good.
Okay. So he's squarely in that 22% bracket. So now he's got 38,000 of IRA income, 25,000 of Social Security. So he's going to pull an extra $1,000 from his IRA. So he's got a special concert road trip coming up. So how much tax will he owe on that $1,000? So most of us would look at a tax table and say, okay, 22% marginal bracket times that $1,000, and it should be $220, right? So that would be the easy answer. As we know, brain teasers are never that simple, and the answer would be wrong if that's how you calculated it. He owes $407, which would be a 40% tax rate technically on that additional income that he's got coming in. So how is that possible if he has that marginal bracket? And we're going to see where there's potentially kind of those areas within the tax brackets where a little bit of extra income can cause a much higher rate of tax on that additional income. So sometimes if you're close to those thresholds, it may be something just to kind of pay attention to. Grand scheme of things, for most of our clients at this point in time, your effective tax rate, and so we're going to get into that. The effective tax rate is still relatively low. So reminding clients, hey, with the taxes that you're paying, you're still usually keeping a pretty large percentage, of those taxes. So we're showing you here 22 versus 23 tax brackets. So as you can see, thankfully, the government is allowing us to make a little bit more and still be in that tax bracket. So we see that this year for a single taxpayer, the 12% bracket goes all the way up to $44,725. So that's an increase from $41,775 in last year. So we can make a little bit more and still be in a lower tax bracket, if you will. Now we call these marginal rates. And so we can't just, as you saw from the previous slide, I can't just take 44,000 and multiply it by 12 and come up with the amount of tax that we owe. So it's a progressive system. So on the first 11,000, we would pay either zero tax on that, or we call that a 10% marginal bracket. But then between 11 and 44, that would be taxed at 12. So the effective tax rate is really an average, is probably the easiest way to kind of say that. So, here's an example. We say we've got somebody making 89,000 of income. They're in that 22% bracket. However, on that 89,000, they're in an effective tax rate of 17. So how do we come up with 17%? If we take the taxes that we owe, we divide it by our taxable income, that gives us our effective tax rate. So I thought I'd bring in a real world example here from a client of ours that we have. So this is looking at, I think this one is 2019, 20, and maybe 21 taxes for this individual client. So, they have 29,000 of income coming in. This is kind of an interesting example, is that if you look at their Social Security, this was a client that had a spouse that had passed away. And so they went from their own personal collection of Social Security onto a spouse. So you see a significant jump there in income from year to year. But so, we look at, let's say 30,000 of income, their taxable income is only 16,000. So we'll look at some deductions and see where that is. But if you look at the tax that they actually owe, they only owed $776 of federal income tax on $30,000 of income. So you look at that, in some clients' cases, their taxable income may be, fairly low. So if you look at that, so on 30,000 of income, paying 776, they only paid 2.6% is really their effective tax rate. Now, if you take that 776 divided by their taxable income, it's 4.8. So then this client had a pretty big jump. They got 14,000 more dollars of income, and yet their tax only went up $1,100. So in some cases, some clients, depending on where you're at in kind of those brackets, fairly low. So this client, as a single taxpayer, was bumping up against this top end of the bracket, but still only paid $1,100 in tax. And so you can kind of see how that, worked out there. Fairly similar to kind of what the brackets were. So so that's what we call the marginal and effective. So, and kind of the question we get a lot of times for clients is number one, okay, well, I'm getting ready to retire. How do I know how much tax to withhold? And as I get ready to retire, don't I get some kind of a special break, So either that, or, hey, I'm getting older, as an older person, do I get a special tax break? There's got to be a special tax break for either retired or as we age. And unfortunately, we really need to start, these tax tables are where we've got to go to really begin that process of figuring out, okay, what tax do I actually owe? But then also understanding the deductions that we have in this effective tax rate also kind of comes into play. So we're going to look at kind of some different areas of income that may have some special advantages. So when we looked at this client's income here, we can see that this client had some interest in dividends. There was they took some gains on their investments. They had IRA distributions. They had some Social Security income. And so, there's different types of income that we're going to be collecting in retirement. So first thing to understand is that having qualified dividends. So let's say I own Coca-Cola, or let's say I own a mutual fund that has all dividend paying stocks inside of it, and it's paying some dividends to me. Most of those dividends are what they call a tax favored type of income. So let's say I buy Coca-Cola at $50 a share and I sell it for $100 a share. That $50 in gain is going to be considered a capital gain. So there's a 0% rate, depending on where I'm at income wise. There's a 15%. So depending on your income range. So as a single individual, I can make all the way up to $459,000 of income and only pay 15% in tax on that. Well, if we were to go back and look at our marginal rates again, right, as a single taxpayer, 400,000 of income, my ordinary income, I'd be paying at 35% rate, as opposed to now my long-term capital gains or corporate dividends are much tax favored. So that's kind of a big debate. You guys probably are seeing that. I don't know. I turn on CNBC every day and watch CNBC, so I get to hear all the all the kind of technical debates on that. But so they're trying to find ways to have the top 1% pay more in tax. So if I'm a very wealthy individual, I may not have any income, no W-2 income, which would be taxed at a much higher rate. Maybe all my stuff is coming from capital gains and qualified dividends. So they're trying to find ways to have maybe increase the taxes on the super wealthy, the super rich, and so we're kind of seeing some swirling tax debates surrounding that. So a lot of us may have some different or these types, but a lot of us have what they call traditional IRAs, right? Or Roth IRAs, or we might have a 401k or a 457, 403b, defined contribution plan. So essentially, one of the things just to realize is that the money that we've been taking deductions on, and that's been tax deferred, the traditional IRAs, 401ks, 403bs, we're going to pay taxes on those, and that's going to be considered a taxable income coming out. We may have had an opportunity to save maybe money in a Roth IRA. So we didn't pay tax on that going in, but that's going to all come out tax-free. When we're retired, there's a 5-year waiting rule on that, but Roth IRAs are non-taxable coming out. Now, state taxes, kind of been talking federal. We're going to set state taxes aside, but there are some state taxes that don't tax IRA money. So Florida, Pennsylvania, Maryland is talking about. Maryland actually passed some rules about not taxing retirement distributions, but like most governments, they haven't really given us what that meaning of of non-taxable distribution is. So they haven't quantified that. So from what I gather, there's going to be some type of a phase out if you're in Maryland. But so Maryland, I think, is trying to compete with Pennsylvania on some of those distributions. So most of us are trying to take are trying to decide, do I take a standard deduction or do I itemize my taxes? So It was the Tax Reduction Job Credit Act. I think it was TRJA or whatever they called it back when Trump was in office. So what Trump did is he doubled the standard deduction, took away an exemption, but doubled the standard deduction. And so for most people now, as we can see on the slide here, 90% of taxpayers are expected to take the higher, just the standard deduction. And it did save some taxes on that. So it did kind of do what Trump was, I think, trying to do was lower folks' taxes. So, so what is the standard deduction? So this year as an individual, I can offset 13,850 of my income. So they call that a deduction, right? So we saw in that example with that client of ours where 44,000 of income, their taxable income was 30,000. So that deduction reduces the amount of our taxable income, right? So that deduction, I think, went from $6,000 before Trump to around 12 or 13,000, and then of course they raised that with the inflation rate every year. So you can see it went up about $900 from 22 to 23. So here's the what you get as either an older individual or someone retired. So 65 or older, the government gives you a whopping $1,500 or $1,800 of additional, standard deduction. So I guess that's one thing to cheer about if you're going to turn 65 this year. You get a whopping $2,000 additional deduction coming off of your taxes. So that's a standard deduction. So every individual, if you have nothing else, gets to reduce their taxes by this standard deduction that we have. So, all right. So we talked about, I have the choice of either itemizing or I can take the standard deduction. So, why would I, what comes in as an itemized deduction? Well, so if your medical expenses are above 7.5% of your adjusted gross income, so, let's take our client, $40,000 of income, 8% of that roughly is what, $3,200. So if I have medical expenses that exceed $3,200, anything above that. So first 3,200, I can't deduct. Anything above that, I'd be able to say, okay, well, that's an itemized deduction. So, that's state and local income taxes, but that's limited to a total deduction of 10,000. So you can begin to see how, and I don't know why the government, it seems like the government really wanted everybody to kind of take that standard deduction, but you can begin to see how it gets difficult to kind of go above that standard deduction threshold. But mortgage interest, charitable contributions, some investment interest expense. So, and then on the other hand, the government took away some of the itemized deductions. So if you're working for a company and let's say I want to buy a tool for that company to maybe make my job a little bit easier, unfortunately, they took away some of those expenses, moving expenses, home office, tax prep, professional dues, casualty. So, the government did take away some of the itemized expenses that we would typically use. Charitable donations are still a part of that. So we saw that. So, we have some clients that are very charitably minded. So you can deduct up to 60% of your adjusted gross income if you're so inclined. So, again, making $50,000, if I want to give $30,000 to a charity, that would be above the standard deduction. And I could write that off on my taxes if I so choose. So charitable deductions are still part of that strategy. We're going to talk about a qualified charitable distribution later, and maybe something that folks want to consider. So it's basically where at age 73, I'm forced to begin taking money out of my retirement account. So if I don't need it and I want to give it to a charity, I can designate a charity that's going to get that RMD, required minimum distribution. So I can just allocate that directly to a charity and not get taxed on it. So we also have some folks, we've had a couple of situations where this has come into play, where we want to contribute to what's called a donor advised fund. So a donor advised fund is essentially where I can take money, I can contribute it to basically my own charity, if you will, and then I can tell my charity, okay, I want to give, and I think you have to distribute 4 or 5% of that balance every year. But so I could take $50,000, put it into my own little self-directed charity fund. Then I could say, all right, well, every year I'm going to give $2,000 of that to my church. I could give $2,000 to the Humane Society, $2,000 to whomever. So that $50,000 donation that I put into my own self-run charity fund, I can then say, okay, but I'm forced to give out at least 4 or 5% of it a year. I can give more, but that's the minimum. So donor advised funds, maybe possibly if I have a large stock that I don't want to sell, take the gains on it, I can also give that to a charity. So, we have some folks giving to University of Maryland, some of their, alma mater, something like that. Could be a way for us to do that. So, and you can go back and forth. So 1 year I may want to take the standard deduction, and then maybe the next year, okay, well, I'd love to give a large donation to my alma mater, and heaven forbid, maybe I have a lot of medical expenses that year. So, in some cases, if you bunch all of those into 1 year, you can itemize 1 year and take the standard deduction the next year. So you can go back and forth between those. Child tax credit, if I have someone under the age of 17, I can deduct up to $2,000 per dependent. That is a phase out, as in most things. Heaven forbid you make more than 400,000. You seem to be right in the bullseye of Biden and his administration. So heaven forbid, make sure you don't make more than 400,000 as a married filing jointly, because you're going to be considered super rich and you have to pay more in tax. So watch out about 400,000 and up. So tongue in cheek, right? All right. So savers tax credit. I really wish this just is almost abysmal, but so if I want to put some money into my 401k and I'm making less than 41,000, I get an extra credit for that. So 41,000 is pretty low type of income for someone married filing jointly between you and your spouse, making less than 41,000. It's a pretty low threshold. So I don't know why the government doesn't change that a little bit, but there is a savers credit that's out there. 529 plans, there's been some recent changes to those. One is you can use them for K through 12. So 529s really came out for college expenses, but now you can use them for K through 12. The great change they made in December, late in the year. So they waited until the very last year to change this, in that you can now roll that to a Roth. So every single person in the whole country had already planned on, if I need money out of my 529 plan, I got to get it out for the year to offset my expenses. And then the government comes in and says, oh yeah, by the way, no, you can roll up to 35,000 of that to a Roth. So everybody had already planned on taking their distributions. They had them out, and then the government changed the rules on us right late in the year. And so there's some interesting things happening in the 529 market you may want to think about. So here's kind of an interesting thing as we go through. So we kind of talk about the 4 different kind of stages that you kind of go through. And of course, you may or may not fit the typical profile. But, a lot of us in pre-retirement, right? So we're trying to either shove as much money as we can into our retirement accounts or into savings. So we kind of call that the pre-retirement, right, years. So, and we're trying to gear up for that, the day we're going to retire. So in our 60s and 70s, thankfully we may have eligible for Social Security. We're starting to plan on traveling, where we're going to move. Are we going to go somewhere different? Go somewhere warm like Maryland that's hasn't been below 70 degrees this whole winter time. So we'll take it, right? But traveling, volunteering. As we get into our 70s and 80s, we begin to slow down, maybe begin to kind of think about, estate planning, where my assets are going to go, late retirement, if we're hitting some medical expenses, and then really beginning to kind of plan on asset distributions and things like that. But so, you get accustomed to kind of your lifestyle and how things are going, and we begin to kind of think about retirement. And so things obviously change, right? So now I'm going to collect Social Security. How do RMDs impact me? When do RMDs happen? And so the government is postponing those and having to take those later. Medicare, long-term care, all things we're having to begin to think about. And this isn't always necessarily true. So I think sometimes, we put out these little headlines for some shock value, but in some cases, you can end up paying more in taxes in retirement. So I've got a slide later on where, we've done some projections for some clients and kind of looked on that and looked at that. So it's not always the case, but in some cases it is. So the one client I think I'd shown you initially on this client lives very simple lifestyle, so they don't need a whole lot of income, and you could kind of see. I mean, she's paying $800 in tax, or $1,100 in tax on about 45,000 of income. So in some cases it's not always true just to say, well, you're going to pay more in tax, but it's always good to have a solution, and that's really what we are here for, is to be able to help kind of plan that out for you, and to show you, what the future may look like and kind of where things are going to come from. So it's always good to plan and kind of have a strategy, what different things are going to cause taxes for me. And it may not always be a tax per se, but if it's going to cost me more money, we kind of call that a type of a tax. So retirement surprises, inflation, longevity, what type of expenses, healthcare. And, I've seen some numbers of how much clients are going to pay in retirement on healthcare, and it just gets kind of scary, really, quite honestly. So in some cases, I look at the projections from some of the research facilities that are out there and saying how much you're going to pay. For some, we somehow usually are able to kind of, plan around it, but let's see here. So anyway, so those are some things to think about. Inflation is running a little bit hotter than normal right now. So what is that going to do to our, retirement? All right, so retirement taxes, we're going to begin to kind of dive into that. The first thing we have to understand is, so we've got these buckets of money we've been saving. And so what type of implication does that have for us? So, kind of a simplistic example here, but let's say I got 500,000 in my 401k or my IRA, maybe I roll it to my IRA. So I got 500,000 saved up. As we said, that's a pre-tax, right? So I'm going to pay tax on that on the distribution. So a lot of times we'll want to assign a withdrawal rate to that. So, we'll look at the portfolio and say, okay, well, I really think this thing is going to grow at maybe 7% through retirement. So, maybe I can withdraw maybe 5% of that balance. So 5% of 500,000 is 25,000 a year. So maybe we want to assign it maybe a 10% effective tax rate. Again, depending on your income, maybe we need to bump that up to a little bit higher, but so in some, we're just some things to think about. So 10% effective tax rate, we'd need to withhold $2,500 over the course of the year. that's going to net you 22,500 in a take home, right? So the money we have in our pre-tax that we're going to pay tax on obviously isn't worth that full amount on the way out, because we're going to have to account for some taxes on that. Now, we just ran an example for a client here recently. Client started with 275,000 of a balance. They've taken out $200,000 a year, roughly about a 5% withdrawal rate a year, and they have 300,000 still left after a 13-year withdrawal period. So, it's possible to be able to keep up and still maintain that balance. And for most clients, that's kind of what we're looking for. Now RMDs, so your required minimum distribution. So whatever you're taking out of your IRA, so if you hit that magic retirement age where you've got to begin taking it out, whatever you're taking out counts against that RMD, or let's say you hadn't begun taking anything out of your retirement account, you're now forced to begin to take money out of your retirement account. So one of the things we do for clients, and it's on your statement, is your statement will tell you what your RMD is for that year. So that age now is age 73, and it goes to age 75 in 2033. So in case you guys need to plan for 10 years down the road, it's going to age 75 in 2033. So government is beginning to recognize, hey, we're living longer, so maybe we need to postpone those RMD ages a little bit. All right, so how about Social Security and Medicare? So, we're trying to generate kind of sources of income, but Social Security and I should be able to have that for Medicare, and that is true. But sometimes there's some things we need to think about for Social Security and Medicare purposes. So, so we're going back to kind of Bill. We remember Bill went all of a sudden 40% of that extra $1,000 caused him to pay an extra $400 in tax. So, we see here that his IRA income only went up $1,000, yet it cost him $456 in additional tax. So, where did that come from? Well, we call that kind of a Social Security tax torpedo. So what does that mean? Well, if I can keep my income low enough, so if I'm a single individual and my taxable income is less than $25,000, I would pay no taxes on my Social Security. So, some clients are like, great, keep me below 25,000 of income. And usually our answer is, well, can you really live on 25,000 a year? So it's a two-edged sword, right? But so where does this number come from? Where does that tax-based number come from? Well, the calculation starts with, we take half of their Social Security benefits, and then we add all other income to that, including tax-exempt income. So, back to, well, let's just use, well, here we go. There's an example down below. Married couple filing jointly, they have adjusted gross income of 30,000, tax exempt of 3, 24,000 of Social Security benefits. So we take half of the 24, which is 12, and we add the tax exempt and all other income to it. And so if that threshold is 25 to 34, we only add back 50% of your Social Security as taxable income. As soon as you go over 34,000, up to 85% of your Social Security is taxable. So what do we take away from this? Just realize that there are some brackets there that we need to think about. So, if my tax base is only going to be 33,900, and I want to take out an extra $1,000, it's going to bring an extra 35% of taxable income potentially into that calculation. So just keep in mind that there are some thresholds there. And in some cases, if I'm going to pull out an extra $1,000, why not pull out we call it kind of filling up to that tax bracket, right? So I think in the beginning, the single individual can make all the way up to 44,000 of income and still be in a 12% bracket. So, you know, if for some reason I'm between 25 and 34, I go over my 34, well, heck, I might as well take out an extra 10 more thousand, and that's all going to be taxed at that 12% rate. So it sometimes is important to pay attention to those marginal rates and brackets and kind of factor that into the planning. So so as we approach retirement, a lot of people are kind of thinking, okay, you know, what do I want to do? Do I want to retire completely? Maybe retire and work a few hours? You know, maybe I love some of the things I'm doing. So just maybe semi-retire or retire and volunteer. And, you know, at what age do I do that? In some cases, people are thinking about, you know, maybe let's say I started working later in life. You know, or for some reason, maybe I stayed home and was helping to raise kids or something like that. So in some cases, we may be trying to maximize our Social Security benefits. So we've got some calculators out there that can kind of help you look at that. In some cases, if you've had a very high earnings career, maybe that's not important for you. But replacing zero or no earnings can have a dramatic impact on the amount of Social Security you collect. So one of the things we got to be careful of is that if I retire early before your full retirement age, so make sure you know what that date is. So if I retire early, but I continue working, it's possible I can lose benefits. So if I make over $21,000 and I haven't reached my full retirement age and I'm collecting Social Security, I lose $1 of benefit for every 2 earned over that. So for a lot of people, this calculation is pretty awful, meaning that, you know, let's say I make an extra $1,000. You know, I could lose 2 divided by that 1,000 is 500. I lose $500 of benefits for just making an extra $1,000 of my Social Security. So either work with your employer to get paid under the table, cash under the table, which we're not allowed to recommend, right? So pay your taxes, do what's right. No, but just, you know, be aware of that, be aware of those thresholds. Yeah, we talked about, you know, kind of filling up that 35-year span. So that's important to understand. So go on to Social Security website, run those numbers. It's pretty self-explanatory, but go on to socialsecurity.gov. I think it's ssa.gov or something like that. Log in, create a profile, run your 35 years and kind of see if you need to kind of max out, if you will, your Social Security benefits in that regard. So, all right, so we're going to use a fancy term here called IRMA. So income related monthly adjustment amount. So what is a fancy term for IRMA? Well, we have George and Martha here, and we've got parts B and D. They've got $275,000 of income. They sell a stock for $1,000. They're going to owe $188 of capital gains tax on that. And of course, is that correct? Is that all the tax? Well, guess what happened to poor George and Martha? Well, they went over a threshold. So the more you make, the higher your premiums. So poor George and Martha went from 275 to 276. Their Medicare premiums just went up by $237 a month. So needless to say, just watch these thresholds. They're income related monthly adjustment. So they're for a single payer making more than $88,000 a year, you pay a little bit more. Again, so just be aware of those brackets that if you are, you know, selling a stock, selling your home can kind of come into play, and that's a capital gain. Realize that your Medicare premiums is a 2-year kind of a look back and can affect your taxes for the next couple of years. So just an extra $1,000 of extra income really hit them with an extra $2,700, whatever you want to call it, increased costs on their Medicare and taxes combined. So sometimes we got to watch those thresholds there, just like we do for taxes. So the other thing we got to watch out for is the timing of enrollment. Make sure you understand when you need to enroll. Please don't miss that date. It can be, and there's extra penalties on that. So again, not quite a tax per se, but you don't want to have to pay more for your Medicare taxes, for the rest of your life. That's a tax you don't want to miss at all. So other types of things we may want to think about is when we're going to use the buckets of money that we have. So in some cases, some things are going to be taxable, tax deferred, and maybe tax free. So how do we want to use those? So we've got our lovely couple here, Sam and Mary. Sam and Mary have done a fabulous job, saving. They've each got their IRAs, Mary's Roth, Sam's Roth, and then they've got 300,000 in the bank. So as we look at these assets, the Roth IRAs are tax-free, the IRAs are taxable, and they can pretty much use their joint bank account without any kind of a tax implication. So Sam and Mary have kind of set out a budget of $8,500 a month. So how do we coordinate which one of those buckets we want to use first? And so, conventional wisdom may say we want to take the taxable money, then maybe our IRAs, and then maybe do the tax exempt money on the back end. Because sometimes later in life, you can't control maybe health expenses, but you can control withdrawals from the IRAs. So kind of you're kind of coordinating that maybe and in control of when you withdraw it. But one of the things we may want to look at is it possible to even convert some of those IRAs to Roths in your low tax years, and then you've got larger tax-free money to spend on the back end. So software helps us to be able to kind of walk through that, and it's specific to everybody's personal situation. But in this example, we're just kind of saying, okay, well, let's do a conversion, and how would that look with this particular client? So I thought I'd bring in here a real world kind of an example that we had done with one of our clients. So as you look at this client, they're 70 and 67. Again, they've got a relatively modest lifestyle, so they really don't need to spend much more than about $60,000 a year. So you look at this client, their taxable income is fairly low prior to when all of a sudden now their RMDs, they've got a fairly large IRA. All of a sudden they've got to take out $70,000 from their IRA. So look at what that did to their effective tax rate, right? Very, very low effective tax rate. And now all of a sudden their tax rate went to 10. And then even look, as they get later in life, your RMDs every year, the government just forces us to take more and more and more and more out. Heaven forbid somebody passes away. So we always assume folks are going to pass away at age 90 in our software. So heaven forbid spouse passes. Now the single taxpayer, they're bearing the brunt of all of the taxation, right? Because they're a single individual, the tax rates now for that single individual. So you can see the tax projection for this client is not very good, right? So that kind of helps us to determine, okay, when do we want to take some of those, some of those distributions? So then we said to this, okay, well, maybe what we should do is do a conversion, right? So we kind of talked about filling up those tax buckets all the way to the top end of our bracket. So, why would I want to incur a $23,000 tax, bringing my effective tax rate up on that conversion Well, look at what it does to this client later in life. So although I'm spending 23,000 maybe now, or maybe 20,000 more additional in tax, look at how much we reduce the withdrawals later on in life. And so here's kind of a side by side. You can begin to see that the total tax, although I'm paying 20,000 now, look at that last example. I'm saving myself almost $26,000 in retirement. So, it's kind of a fluid example. In some cases, not a right or wrong answer per se, but I think sometimes when we're doing this tax planning, you can't dig it down to every last penny and dollar, but you can definitely, I think, make some differences there directionally in what you would want to do. So we call that filling up the bracket, right? So, and even my first example I had with that client, 44,000 was the top end of the bracket for a single individual. So, but with deduction, she probably could take that to 50,000 and really not impact her taxes really all that significantly. So conversions, Roth conversions may be a good thing to kind of take a look at. And again, we've got some really good software that we can help clients to kind of think through that. So understanding those thresholds, understanding kind of where we're at bracket wise can really help to kind of help you to understand the planning that kind of comes into play. So maybe withdrawing tax-free money from life insurance policies, selling highly appreciated stock for low or no capital gains, distributions from IRAs, 401ks. Health savings accounts is something to really pay attention to as well. We're highly encouraging clients to continue to contribute to those. That's another form of deduction going in, and you pay no taxes coming out. The only investment account out there that allows us to get double tax-free possibilities. QBIA, qualified business income deduction, is something it's kind of beyond the scope here a little bit, but if you're a self-employed individual and talking about those brackets, but the pass-through, you get a 20% deduction on that QBIA. So just another form of deduction that's out there. So we've kind of got an example here of charitable giving. If somebody is taking the standard deduction, unfortunately, the $5,000 that you give to the charity, really doesn't help much, unfortunately. You are able to get a $300 deduction if you're taking the standard deduction. So, there is a little bit of help there, but unfortunately not if you're taking that standard deduction. So we talked initially about qualified charitable distribution, QCD. So, our client there that had the really large IRA that they were having to take $70,000 out a year, that client really can direct that $70,000 that they would have to take out of their charity, and they can direct, or 70,000 out of their IRA, they can direct that to a charity. So it counts towards their RMD. So that helps them. They can't get a deduction for it, but I don't have to count it as income. And then the charity gets the good benefit for that. So you can do that in any level. We've had clients do $300 to 5 different charities. So, really, if you're having to do the RMD, the charitable donation directly from your IRA can help you with that. So this little example of qualified charitable donation, as you can imagine, if I were to take that $5,000 and then pay tax on it, and then I give it to the charity, I lose some of that benefit, right? So if $5,000 is really what I want to give to the charity, or whatever amount, there's no reason for me to take it from my IRA, get it in cash, have it be taxable, and then I pass it on to the charity. So if you truly want to give to a charity, we can have it go directly on from the IRA. So So then, so now we're talking about assets that we want to pass on. So in some cases, so now we're kind of getting into the estate planning part of kind of maybe later in life. Okay, maybe there's some things I want to in ways to organize. Ownership is an important part of understanding kind of the tax planning. Here's an example of a couple, Phil and Mary. They hold things joint tenants, rights of survivorship. Phil passes, goes to Mary. Mary passes, goes to Phil. They've got $120,000 investments, and they have a long-term capital gain. Heaven forbid, Phil's diagnosed terminal illness. He's going to pass in 18 months. So what do we do with that asset? Well, joint tenants, rights of survivorship. Phil passes, Mary inherits Phil's. She gets what's called a step up in basis. So Phil passes, Mary gets the investment. She gets to step up the gain on that. So 120,000, half of that is 60. So Mary gets to not pay tax on that $60,000. However, there's still 60,000 that's out there. So is there a way kind of around that? And there is. So Phil could have taken ownership of the entire 120,000, and then heaven forbid he passes. Now Mary, since she's not considered an owner on that particular investment, Mary would get the full step up in basis on that. So I think this is, and we're going to do an estate planning seminar here in March. So this may be something that we can definitely dive into in a little bit more detail later on. And of course, our question is, do you want to pay tax on 60,000 or do you want to pay no tax? So pretty easy answer on that one. So how about IRA? So this is really an onerous kind of a change on the estate and inheritance side of things that government changed the rules on with the Secure Act. So mom, Pamela, 65 years old, Kyle, loving son. Pam passes and leaves 100% of the IRA to son Kyle. Previous to this, Kyle would have been able to stretch that. He could have, first of all, waited until Pam would have been age 72 to take an RMD, and then he could have stretched it over his lifetime. But the new rules come into play that Kyle's got 10 years to get the money out of the account, and he has to take what's called that RMD. So he's forced to take money out of that account. So 6% rate of return, $400,000 balance. Kyle basically has got to take out $54,000 a year. At the end of 10 years to a beneficiary, all of the money has to be out of the account. Now, if he would wait until the final 10-year to pull that out, it could have grown to $716,000. So you can begin to see how onerous, how'd you like to receive $716,000 in an inheritance all in 1 year? You're talking about blowing up your taxes and your brackets. That's a good way to do it. So I think with this change, it's become more and more important to really look at assets you have, how you're going to distribute them, what you're going to do with them. This kind of example here, I'm going to not spend a whole lot of time on it, but taxes and long-term care. So we're kind of talking about later in life. Depending on where my assets are and how they're positioned, can really, cause some kind of tax disruption on the back end. But so you may have maybe long-term care, maybe a policy. That policy could be inside of a life insurance policy. It could be inside of an annuity. And so kind of depending on my assets, right? So so if we look at this kind of example that we've kind of developed here, so Florence qualifies for long-term care benefits. She gets $60,000 a year and $20,000 a year in Social Security. Well, she has an IRA, and then she's got a life policy with a long-term care rider on it that's going to pay $10,000 a month. So how does Florence or her advisor kind of guide her, which asset should I take first? Should I take from my IRA, maybe from my life insurance? So, well, Florence pays little to no income tax during the last 5 years because she's got high unreimbursed medical expenses, and her long-term care pays $300,000 for her in-home care, so 60 grand a year, right? So, kids would inherit 200,000 as well as the 400,000 of the taxable IRA. Is that the most tax efficient way of paying for care? Well, maybe we would want to use the IRA because, again, we've got a lot of medical expenses that we can offset with that. So unfortunately, that Medicare, Medicaid, end of medical expenses and life type of planning gets to be pretty complicated with what you have. So, needless to say, it's an important time to really pay attention to, what we've got and how we're gonna manage it. So we get this from clients a lot of times. They're like, Dave, it seems like the more money I get, just the more complicated things get. I want things to be back to more of a simple, back when I could just work and save, and it does get fairly complicated, but again, that's kind of what we're here for, is to be able to help you through those stages in life that we move through, and can help guide you, as you move through those stages in life, and try and be, thankfully we've got some good software we can kind of help show you that and what that looks like. So, we need a strategy. And like I said, there's only so much that we can control, unfortunately. And some of that, so sunset of taxes happens in 2026. So the Trump taxes sunset, meaning they revert back to the old ones. And so I looked at those rates just to kind of compare them a couple months ago, and there was about a 3 or 4% reduction in all of the brackets. So if nothing happens between now and then, plan on a little bit higher taxes a couple of years from now. But unfortunately, we can't control what Congress does and what they do to our taxes and all of that. But definitely we can do some planning there around all of those. So it can be kind of a complicated process, and managing taxes throughout obviously is something to think about. And sometimes if we're not kind of planning on it, you can have some unintended consequences of Roth conversions or something like that. Big sale of a property, big sale of a stock or something like that can have a dramatic impact. So, well, thank you guys. With that, we're at the end of our presentation here. I think everybody's on mute, so hopefully you can work your little taskbar down there if you have some questions. I think if you press your space button, I think that unmutes you, so you unmute you for a little bit. So if we have some questions, happy to take those. Happy to meet with you. I know we've got some planning stuff out there for some folks we're working on, and so we look forward to helping you guys kind of work through this if you'd like with that. So Allie's going to send out the slides and the questionnaire. So if there's something you want to shoot back to us, definitely let us know, and we'd be happy to help. So. Any questions? And yes, I think we're going to get a major snowstorm in February or March. So I still need to get my skiing in. So I am predicting a major snowstorm. So hope you guys don't mind.
Yep, I wanted mine skiing, so.
Hello, this is Dovey.
Hey, Dovey.
I just want to thank you for putting this seminar together. Very informative, a lot to think about, and I trust that you have me where I need to be and all this good stuff.
Pretty well positioned. Yep.
Yeah, all that with the IRA and everything.
Yep.
Okay, well, thank you for doing this. It's been very good, very
Yes, you're
informative.
welcome. All right, guys. Well, thank you then. And as we said, just respond if anything comes to mind. You know, definitely shoot us an email, respond to Ally, and we'll get your questions answered. So with that, we're gonna end our seminar here.